Let's now continue on that thematic and look at those issues that have actually influenced the housing market this year and what's to play out next. Anthony Landahl joining us from Equilibria Finance. Welcome.
Nice to be here.
Now, we just heard from Eliza there about obviously that mismatch between supply and demand remaining in place. Property growth may come off a little because of affordability issues, obviously, but perhaps from an investor point of view, what are we likely to see, do you think, next year?
Yeah, Eliza just touched on the fact that the market's grown about 8% this year. Investors came back in 2025. Their credit growth was around 13% on the 12 months before. In terms of what we're thinking we'll see next year, I think we'll see a little bit of a contraction in investor growth. Investors came back on the back of the interest rate cuts. The cost to come into the market was less, the cost to maintain the debt was less. Investors also were using and accessing equity. I think we probably will see a little bit of a contraction in investor behaviour, but it's a little bit of a harder one to read because investors are looking for some of those more affordable suburbs. They're looking at more specific investor grade properties, whereas the owner occupiers, they're actually priced out of some of those markets. So I think investors will stay strong. They may not be as impacted by some of the uncertainty around what's going to happen with interest rates. Will we get a rate rise? We might see a bit of a contraction because of a lot of investors sitting on the sidelines came flooding in 25.
Are we seeing the investors compete with the first home buyers still at this point, and how is that being influenced by the outlook for interest rates?
There is some competition amongst those more affordable suburbs. Elijah just touched on some of the areas investors are looking at are probably not where your home buyers are looking at. Some of those mining areas, you get your stronger rental yields, they're more an investor market, but there are a lot of investors that fish in the same pond as first home buyers, as well as other people looking at shifting markets. Often investors will look outside the major capitals in some regional areas or in areas that are investor grade properties. Home buyers, for affordability reasons, are looking at some of these properties. So it is creating some concentration competition in, I guess, what would be deemed less affordable markets, and the rate of growth in those markets is going up. For that reason, we're seeing investors, first home buyers, and people may be looking at upgrading from a unit within a city area to a house in a more affordable area, all now competing in the same markets.
What's the likely impact of further prudential regulations? APRA essentially looking to make it a little more difficult, I guess, to dig deeper in terms of a home loan?
Yeah, APRA's been looking at essentially higher debt to income ratio loans. So where your debt level is, where your debt is 6 times your income, they're capping that at 20%. So a lender can't go over 20% of their book at those levels. I think it'll mainly affect the major banks who lend more at those, I suppose, higher risk loans. And I think it's more going to affect the higher end of the market where people are really trying to push their capacity. It'll have a little bit of an impact. I don't think it'll slow down demand because a lot of the demand is coming from some of the schemes helping first home buyers, newer buyers into the market. I think it'll more just shift some of the behaviour of the banks and maybe shift where people are looking at getting a loan from.
Does that also apply to investor loans?
Yeah, it's going to apply to any facility.
Yeah.
Those higher end, those caps. It's 20% of their book.
All right. So, Anthony, overall, then, what do you see as the major factors influencing those moves next year?
Look, I think the major things influencing next year is going to be interest rates. 2 or 3 months ago, we were talking about would there be another 2 or 3 rate cuts going into next year. Now we're talking about will there be 2 or 3 rate rises. That's going to have a massive impact to sentiment, to borrowing capacity and what people are able to do. We saw borrowing capacity over the last 12 months on the back of the 3 interest rate cuts. We saw borrowing capacity go up 10 or 15% in some cases. So it will have an impact. The market's driven very much by emotion, as we both know. So I think we'll probably see on the back of a bit of uncertainty around interest rates, potentially a little bit of a slowing in that demand. The rate of growth might slow. I think the other major factor, and Eliza touched on it there, was there's no resolution to supply. Supply is going to remain a major issue in the market. Low stock is keeping prices up, and we're seeing low stock for a number of reasons. We're not able to build the volume of properties that are actually needed, and we're also seeing people who maybe in time will downsize. We're seeing people hold on to their properties as well. So stock's not coming onto the market, and we're not getting new stock into the market as well. So I think they're probably the main issues next year will be around what happens with interest rates and also supply. Where does that land? Supply is down year on year at the moment quite drastically.
And outside of property, what are you seeing in regards to sentiment in with small businesses and loan demand there?
Yeah, small business sentiment and business sentiment in general is quite strong, and I think that's one of the issues that's been touched on recently with these inflationary numbers is we're getting quite strong business growth and business sentiment. We're getting pretty strong appetite and volume and discussions around investment in commercial properties, business owners looking at buying their properties. We were seeing for a period of time a lot of cash flow requirements around managing their business. We're now having discussions more around business growth for cash flow requirements, for overdrafts and stuff like that. So we're seeing a little bit of buoyancy in the business community, albeit there are some sectors that are still struggling. But generally speaking, we have seen an uplift in business finance needs for investment, which is a good thing.